Good afternoon again, and welcome to our first live panel discussion for the day. So the topic today that we're discussing is, does international property management add value to a building? Now, this panel will shed light on how the role of an international property management can or does it really add value to a building, and also address how owners today can be a little bit more better prepared and protect the value of their investment. So I'd like to start off by introducing the panel to you. So we have here with us Mr. Arron Browne, the COO from Kaizen Asset Management Services. We also have Mr. David Pine-Coffin, the Head Property and Asset Management Services from JLL. And we also have Ms. Esra Fanoscu, the Regional Head of Corporate Real Estate MENAT, the HSBC Bank Middle East Limited. And of course, we also have Mr. John Stevens, the Managing Director of Azteco Property Management. Now, the session will be moderated by Ms. Lindsay McQuillan, the Director and Head of Property and Asset Management CBRE, the Property Management Middle East region. So viewers, please do note that the Q&A will be held in the last 10 minutes of the discussion. However, I do encourage you to post in your questions, but our moderator will be addressing them towards the last 10 to 15 minutes of the discussion. And of course, we do have a networking lounge out there where we can take the discussion post the session. So over to you, Ms. Lindsay.
Percy, thank you for inviting us all to speak here today on what could be a bit of a divisive topic. Let's start the discussion. Arron, can I ask you, do you feel property management can actually add value to a building?
I'm glad I got this question. Thank you, Lindsay, because the short answer is, if it didn't, we wouldn't be here having the discussion. You know, I wouldn't be in this position, and property management companies wouldn't exist. I mean, really, the proof's in the pudding. I would just take it from the company I've worked for the last 10 months. Their performance in property management, increasing net asset value, has been evidenced in the last 4 years. Overall, 15% increase in net asset value. But not only that, the actual industry itself of property management is forecast to grow from a $14.5 billion industry globally up to $22 billion by 2023. So that necessity, that need for landlords, investors, property owners to rely heavily on property managers is clearly evident based on the growth of the business, but not only that, the evidence of, from my point of view and from my knowledge of the industry, the evidence of net asset value increasing with good property management. That has to be said. It has to be a good property management.
Okay, and you say good property management. John, can you tell us what does property management, what does that mean?
I think that there's many property management companies operating across the UAE and in the region. I think that property management is a procedural and structured role. It's very process orientated. It's moving to a very technologically orientated business over the last 5-10 years. So I think good property management comes from the company who's delivering it, the processes, the structures that they have in place, and the people. I mean, most importantly, with property management, it is, although technology is supporting us, we are still very much a people business, dealing with our clients, the building owners, and our customers as the tenants. So there's a lot of factors that lead to good property management, but the combination of staff, processes, and people gives you a good property management company.
And turning to you, David, do you think there's a difference in respect of the property management here in the UAE region than you would see elsewhere in the world? For example, London, New York, Hong Kong?
Yes, absolutely. I mean, I think you see similarities, but if I was to split that into, say, a mature market, emerging market, the mature market, you'll see better transparency, especially on cost items, so service charge items. You'll see audited accounts, and therefore the tenants. I just see HSBC, for example, here will want to see the actual audited accounts, so they know exactly how much is actually being spent. So it's not seen as a profit item; it's just seen as purely cost and revenue. I think in the region here, I mean, I've been working here for over 10 years, and I think we've seen a dramatic change. And I think things have got a lot better here with things like procurement, getting the correct facility managers in place who understand the assets, asset registers are complete, as-built drawings and things like that are readily available. It's always a question we ask, because if you take on a new building, if you don't have as-built drawings and you don't know what the building is, it's very, very difficult for you to maintain and manage it. And I think we've definitely seen a big shift, especially the last probably 3-4 years. And I would say that now that a lot of international corporates coming to the region really demand high quality management. That could be international or local, but they want to see transparency, they want to see health and safety, they want to see things, especially now with COVID and things like that, that people are active and they're managing the occupiers and the tenants in that building.
Esra, do you think what David's saying, do you think that is true for your business as well?
Yeah, absolutely. I mean, speaking about sort of a client point of view, as I am and the team, my team is managing also all the real estate portfolio for the bank. So we have our freeholds, we have sublet properties across all the Middle East. So we're managing around 2 million square feet, above 2 million square feet of portfolio for the bank. And that's absolutely right. So David really actually is right, because I mean, as long as your whole property in good shape in terms of maintenance, in terms of technologies follow through, so you're increasing the value of the portfolio, but also you're increasing the life cycle of the assets. So that's also very important to mark. Not just only we are responsible for our people living in the building in terms of technical maintenance, health and safety, we're also responsible to really actually look after our current buildings in good shape. So that's why in HSBC, I could tell from my experience, so we do have a very serious management processes. A team is really actually using the last modern techniques, procedures, and we also work with all the companies like like GLL, like CBRE, to manage our assets.
And do you believe that your expectation of how your property is managed is the same across the globe, or does it change country to country, region to region?
Not necessarily. So in HSBC, we have a standard operation processes. We call it SOP, and this is not changing on a country basis. Of course, the regulation or statutory maintenance related activities can be vary market per market, but the standard operating manual is the same for HSBC for above 70 countries across the globe.
Arron, coming back to you, just in respect of back to the point on value, what do you think are the key components that are driving value from a property management perspective? What are the most important things, and what do you think we will see over the next 5 years?
I think if you look at the components of, well, the basic components of property management, so generating optimal rental income, maintaining occupancy and retention, controlling and lowering the Opex, and looking at the life cycle of the asset as well. When you take those 5 elements alone, and they're not exclusive by any means, those are the key elements you have to control to add to net asset value increases. And they don't work independently of one another. They're very much correlated both positively and negatively. You can look at setting rent high to increase your net asset value or the value of the building, but that's at the sacrifice of potentially looking at increased vacancy rates. You can, looking at, especially at the moment, what we're facing a lot of is people lowering the amount of Opex that's burdened on the building, but that's going to be eventually leading to less tenant satisfaction and potentially occupancy rates will drop. So those 5 elements, I think, are the key to really driving value increase, and they have to be controlled consistently. They have to be intertwined with the relationship with the FM and the service providers, but also the relationship with the landlord or the investor as well. So it's the balance of those relationships, service providers, landlord, the tenants, and those 5 elements all juggled together that lead to increase in asset value.
And given just on value, given the lack of transactional market here, relatively speaking, here in the region, do you think that landlords, owners are actually focused on value?
It's a good question. I think they always are focused, and from experience, that's one of the key things we have to look at when we're coming to annual budgets and reviews. You know, that's always the underlying conversation that happens with our clients. I understand there is a lot, relatively speaking, correct, less transactions, but it's still with, you know, for example, with REIT or any of our other institutional investors, with the shareholders behind them looking always to see the value of that asset. It's what we have to be accountable to and responsible for at all times as property managers. So even though it may not result in a transaction in the short run, and we have to look at the actual, as David said, the maturity of the market, eventually it will get to that stage where it is. So, you know, if you take the maturity of the market in 3 steps, which is the acquisition, the value add, and then the stability of the market, I think we're just between the value add and stability phases. And then at stability, we can start to see a lot more transaction.
You mentioned value add. What do you see as value add in respect of property management? At
the moment, well, in the UAE at the moment, I think, as I say, because we're, you know, let's say we're 15 to 20 years into the real estate market being, you know, in full flow, I think we're looking at a bit more capital injection, a bit more refurbishment, reinvestment in the buildings, looking at the asset register and what needs replacing in that respect. So I think we're at that stage where, especially with the amount of properties coming onto the market now, we have to look at competing with those newer properties. Older buildings, I say older, they're going to be 15 to 20 years old. Older buildings looking at reinventing themselves in order to compete and keep up and retain the tenants that are in there.
David, you mentioned now that the increased amount of documentation which is available, as-built drawings, etc. Do you think other things have an impact on value, that like the lack of PPMs, schedules, life cycle reports, etc. aren't always readily available for buildings in this region? Do you think that will have an issue in the long term?
I think, look, any building that is lacking data is going to have an adverse effect. If you know, if it's, I mean, we've been involved in some, you know, buildings that have been sold, and we will always, you know, prepare a data room. So we'll have a complete data room showing all of the information that's available for that asset, so it's ready there to be transferred. If there's gaps in that data, gaps effectively mean risk in sort of my view, and any risk can then be taken as a way of chipping price, if you like, on an investment. If those are material risks, I think then that is going to affect the value. The question is whether the actual time of the valuation, whether they have access to that data and whether they know truly if that information is missing or not. And that goes back, I guess, to the transparency question. Typically, the buildings that we've worked with, sort of looking at sort of grade A buildings, grade B plus buildings, both in Abu Dhabi and Dubai, a lot of the information is there, and if it hasn't been there, it gets collected by the FM providers, because they have to look and maintain it, so they will bring that data together. The question really is the quality of the information, and is it robust, is it checked, and is it validated? I've been amazed sometimes when we've taken on assets and you get given an asset register and you ask the question, has this been validated? And you either get pleasantly surprised or it's polar opposite. And when you start looking at the data and you actually go around and, you know, and we'll go around and just do spot checks. and you find that the data is from the BOQ when it was first delivered, but no one's actually validated it for the last, say, 10 years, and you know that instantly is going to, you raise a question and a concern. And that's just something we go, it's not something that you want to, it's something that's a risk. We then create a risk register and then just highlight that to the client. But I think in turn, it does affect value if you don't have that data.
John, do you agree as well that lack of data, lack of meaningful data has a huge impact in this region in respect of value?
It certainly would, as David was saying. The lack of data creates a concern on the minds of the investor in terms of the quality and the condition of the asset that he's buying. I think that certainly with JLL and CBRE, the transaction level of full buildings that occur is, compared to other developed markets, is limited. I mean, in my entire time with Estico, since not a single one of my clients ever sold a building. They bought more, but they haven't sold them. So I think that as the market matures, you will see that the lack of this information in any other mature market will have a direct effect on the values of those properties, because as David rightly said, the examples are if the purchaser can't see clearly that the building has been maintained well, that the assets have been taken care of, that the leases are all in order, that they will take this as an opportunity to knock the value down. Those buildings that have all of that data, that it's clear, that it's presentable, that it's transparent, that it's accessible, then that makes the purchaser more confident, and it gives them less opportunities to negotiate the price down again. So I think that's to come. That the market is moving that way, but it's not there yet. And I think that maybe in this the panel here, the majority of us, the assets and the information that we would have on the properties, with the systems and the processes that we're using, will be robust and will be available. But again, that is not the majority of the marketplace that's out there. As David's saying, we all go and inspect buildings. I mean, David's saying the asset register doesn't tally up. I've had building owners tell me, go and have a look at my 10-story building, and we turn up and it's 8 stories. So there's challenges out there in the marketplace in terms of the data and the information and how it's used and kept.
And why, you mentioned there that your clients haven't actually sold any buildings. Why do you think that is?
I don't think that there isn't really we're dealing with a lot of as probably we all are, individuals, locals of high net worth. They have built themselves assets. If they're going to sell the assets that they have, the sales price that they're looking to achieve has no bearing on any form of valuation to support that value. And the challenge is, you do see in the market these transactions occur, that buildings transact at much higher prices than what a value would put a price on it. So the clients that we see are probably approach it from land bank. They're building properties on land that they've had maybe family or they've purchased, or they're looking for assets to purchase. Certainly the GCC nationals, the Saudis and others are coming into the market and looking for assets that they can purchase to build up a portfolio. And in terms of selling it, again, probably like the rest of your panel, we do have discussions with our clients on what is the exit strategy, what are you looking to achieve? And I think that the value that the majority of our clients are looking for is the actual net return, the rental income that they're achieving. Their book value, the price of the asset is not there. I appreciate what Arron was saying in terms of the funds and the REITs. They are looking at the actual value of the asset. The clients who are using these properties are just focused on the value in terms of the rental income that they are receiving after the expenses that they've incurred. The majority of mine, as a family entity, if you are a family, you're probably not even having annual valuations done on your property to work out the value of it. Whereas the corporates and the funds will be having to, as a part of their audits, actually physically, formally value their assets to quantify what the value is.
Esra, from your perspective, do you agree? Do you agree with what John is saying?
Not just only, I believe, the money. I think the time is also an interesting factor in the transaction process. So in the past, we managed different type of transactions. Either we exited from a rental property, or we sold a long freehold, or we sublet. So if your property or premises in good shape, maintained well, papers are ready, legal papers are also important, I would like to highlight here. So the time of transaction is getting much easier or much quicker than the other problematic ones. And time is money. So that's why I think it's another important point maybe we should also highlight here. And what I also see during all these transactions I mentioned here in the region, if you have a well-maintained actually building, either landlords or the investors are willing to take, because they don't want to spend additional huge amount of capital into the building. So if it is in good shape, they're also changing a small amount of really actually interior parts, not touching the whole engineering systems or infrastructure. That's also, I think, important. We also have seen enough really actually in the past. So we had very quick in terms of different transactions completed with that way.
Arron, you mentioned earlier in respect of Opex and given the current situation, the wish to reduce Opex costs. With that in mind, do you think that landlords will be prepared to spend potentially more money to have a more premium property management service in order to drive value, or will it always be a race to the bottom in respect of Opex?
God, I wish it was the case that they would be willing to spend more money on property management. But I mean, our job as property managers, and the conversation we're having increasingly, is looking at sharing that load and sharing that responsibility of the Opex and saying, well, look, you want to reduce Opex, that's fair enough. But put that onto us and let us share a proportion of that and be rewarded for cleverly reducing the Opex. It can't be at the cost of the service. It can't be at the cost of the value and the quality to the end user. But obviously there has to be some consideration of the fact that, you know, there is less rent coming in at the moment. There are tenants that have the options to move away from the property. We've got to put a huge emphasis not just on, you know, looking at Opex reduction, but also retention and why tenants stay in the building, and the happiness index, both residential and commercial. But I think from what I've experienced this year, there's been no difficult discussions immediately on the property management fee, on reducing that, and hopefully that's a result of the reliance on our expertise and experience to make sure that through this very difficult time and the undulating market conditions, we can actually reduce the Opex, but keep the level of service and look to reset that as and when we come through this period. You know, there are cleverer ways of doing it. We can look at, you know, for example, we're bringing in energy efficiency companies where we can't make any further reductions on things like utility consumption. We'll partner with an energy efficiency company that come in and advise on a non-capital injection method of reducing utility consumption going forward as well. So I don't think it's immediately going to have effects on property management fees. In answer to your question, I think it's a reliance on us at the moment to look at areas where we can reduce Opex in the building without reducing that level of service, and also look at long-term strategy of Opex reduction as well. If that means eventual investment in some IoT to look at the consumption throughout the buildings, then that's what we can look at in a longer term, but that won't be necessarily the solution now.
And you feel that clients are receptive to sustainability measures and those sort of things for buildings to drive the Opex costs? It's more of a focus now than it was, say, 5 years ago.
Yeah, absolutely. It's still very early discussions. Don't get me wrong. We're not at the point where we've rolled it out with all of our buildings, but it's very much a concentration from certainly within the last 12 months and looking at budgets of that element of both the sustainability of the building, the energy use, where it's wasted, and it's been highlighted. I think once you see the buildings during lockdown that were emptied, you see the huge drop in energy consumption and other levels of service provider reductions. And you see that actually, with a bit of careful attention on the day-to-day operations, we can make clever reductions. And we have done, before COVID hit, we were making year-on-year reductions just by continuing the same practices. What I think now we have to do is make that actually built into the contract, whereby we are committed to doing that both on a cost basis, but also a responsibility to the environment.
David, just on that point of sustainability, how do you think international firms like JLL, how can they help local clients to promote, given our wider global platforms? How can we help clients to understand this?
On sustainability, I always think sustainability is seen as such a wide topic, and there's low-hanging fruit, if you like, around buildings in terms of the key things of energy reduction, utility reduction, things like that. And I think, as Arron said, and we do exactly the same, work with specialist companies who can come in and look at sort of the technical side of reducing energy costs. One of the big ones that we have for buildings is district cooling, and looking at maybe renegotiating contracts or trying to look at ways that the delta T, so the return temperatures, can be reduced. So we look at that on sort of a micro level, and we do energy audits as well for our clients. Looking at sort of the wider platform of what we can bring to the table, we've been working with two large clients, one in Dubai, and also a large government entity in Abu Dhabi, where we're looking to basically create a sustainability platform for their business. So it's looking at a much wider view of creating sort of CSR policies, net carbon zero policies, helping them in their reporting, understanding things like their utility costs measurements, and reporting that back into their annual reports. And we're very lucky that we have a team in London that we work with, and we're growing our local team here because we just think there's going to be so much demand for reduction and just greater sustainability awareness. And it's the net carbon zero effect is something you see a lot of companies putting out documentations for the 2030 vision, and you see, and that's happening globally and locally. And I just think you're going to see that happening more with the government entities, and then that will come down to more of I'm going to say the smaller sort of private companies as well, purely because it's the right thing to do. And I think there's going to be a lot of pressure. And I think that buildings that can demonstrate sustainability will attract corporate clients, corporate tenants to buildings, and you'll see that will provide resilience in commercial buildings in the region.
And do you think being an international property management firm, does that give you an advantage in this respect?
I think so. I mean, I'm going to say yes because I'm part of an international. I mean, I think we bring best practice. I mean, I work very closely with the sustainability team. We have a fantastic team in Asia Pacific, so in Australia, where there's a real drive for sustainability. So we're able to bring that best practice from Australia, from Singapore, into other parts of the world, and that's a really powerful thing to do. And I just, we're lucky that we can do that. And we can also bring it in from the UK's and wider Europe. And I just think that best practice, if we can bring that to clients, the international clients as well as local clients, but also work with local property managers as well, we want to bring the best practice to the table, but also to improve the environment we all live in and work in. You know, at the end of the day, we all live in the region. We work in offices in the region. You know, I don't work in an office that's managed by JLL or a Mystico or a CBRE. You know, it's where I work is managed by EMAR internally. So it's in our best interest that we support each other. And then as a result, that will benefit the built environment that we all live and work in.
Do you think it's fair to say that the definition of property management seems to be broadening to capture these sort of things like sustainability? We talked about added value. Do you think that's a fair statement?
Yeah, no, absolutely. And I think the big topic and the big question that we're always asked, you know, if your building is sustainable, if you spend money on getting a LEED Platinum or LEED Gold or a graded building, does that add value to your building? My valuation colleagues will always be cautious at this stage, because I think as soon as you start talking about, you know, yield shifts or any sort of change in capital value, it's a big topic and a minefield of information. I think sustainable buildings is all about absolutely cost reduction, utilities and bottom line service charge cost reduction. And I think sustainable buildings is a shift that we're all going to be moving towards. And for the built environment, it's something that we should all do as professionals in the industry. And I think a building that has, you know, lower utility costs is going to be attractive to tenants, whether it be corporate or local tenants. And I just think it's the right thing to do, and it will provide resilience to the built environment.
John, we've touched on throughout this session on technology. I'm keen to understand what part you think technology will have to play in reducing Opex costs and potentially enhancing value over the next 5 years.
You're seeing that technology is really moving into all areas of our business, whether it's the buildings themselves being smart or it's our operations. So if you're managing a building with a good BMS and electric digital meters, so you're able to analyze and pull data from a remote location and actually track the performance of buildings. These are all things that are going to add value, as Arron was saying, to our business and to our operations. I think that this is the type of analysis that clients are expecting from us. They want us to run their buildings effectively and efficiently. And as we've all been saying throughout this presentation, it's access to that data which technology delivers us. I think also in terms of really in the operating side as property managers, when I first arrived in Dubai, property managers' management fees were probably around about 5% of the annual rental. We're lucky now if we're getting to 2.5%. So technology is really facilitating us to be able to deliver the services within the client's expected price bracket by using technology to support us. There's an assumption nowadays that as a property manager, the rent is collected and the leases are renewed. That's not that's not even a question that landlords or clients pose to you. It is the added value that is expected from you now in terms of how are you going to reduce my expenses, how are you going to increase my rental returns, how are you going to serve me as a client. And again, technology allows us to automate the administrative and the repetitive functions of our job and to focus on these areas that the clients are now looking for. So I think that there are companies that may still not be running their property management businesses with a technology backbone. I can't imagine that they're going to be many of those around in 3 or 5 years' time, because I don't think you can survive or deliver a professional quality service of property management without technology supporting you. On the other side, there is the landlords and the ability to work with these landlords and property developers at an early enough stage of the building's development to get the technology that we would like to see in the property. Quite often we get involved as the building's coming to handover, and they've been sold some very nice equipment during the development phase, but it's not really adding to what we would ask for as property managers in the building specification. So again, the earlier a property manager can get involved in a building's development to assist the owner, the more value we can add, and we can ultimately, hopefully, well, we ultimately will be delivering a building that's more efficient to run in the long term, which adds value to him.
Yeah. Okay, thank you. I think now we're going to move just to some questions from the audience. Question from Abdul would like to know how property management helps to decide on rental value. Would anybody like to take that question?
I'll take a go, Lindsay. I mean, I think property, rental value is probably determined market driven, I'd say. You may be able to say some buildings get a slight premium if they have an international property manager, but I think it's a little bit of a grey area, to be frank. I think so. So rental value is very much driven by the market. What I would say is that a quality property management company being in place will give comfort to a tenant or tenant taking space, and especially international corporate tenants. Whether it be any of us on the panel here, but knowing that there's a professional entity managing a building will give you comfort, and that will probably, as a landlord, mean that your rental rates are going to stay stable to some extent, and it will give you that comfort. And I mentioned resilience. I always think quality property management will mean your building is resilient during difficult times. Because at the end of the day, a tenant doesn't really want to move from a building if they spent a lot of money fitting it out, their staff are happy, and it works for them. So as long as the economics behind it work, you're going to probably keep your tenants in a building. And during this kind of market, that's key, I would have said, for a landlord.
Another question from Abdul. John, I think you touched on this. What are the standard property management fees? You mentioned they were 5% of rental income, now probably around 2.5%.
It all depends again on the asset class. If you're managing a grade A commercial building, charging 2.5% might not be feasible. I think dependent if you're looking at a residential, typical residential building, then they might be the ranges that you're looking for. If you're just an individual owner of an individual unit, then again, as an individual management service, you'll be looking at a different range there again, anywhere from say 5 to 7.5%. We're seeing more clients on the larger portfolios and the larger scale constructions. You're moving to what the more mature markets will be, where you are realistically charging on an open book basis for your staff with a performance fee based on achievement of KPIs. So again, it really depends on the asset, the location of the asset, and the condition of the asset. But they're the ranges that you're really looking at, I would say.
Thank you. Esra, a question from Cameron. What are the benefits of in-house property management versus outsourced?
Yeah, I can take this because I used both services, and in the past I outsourced heavily from in-house to outsource providers. So pros and cons in both area, but I think using an expert or outsourced service give you a lot of know-how rather than sticking only with one person or two persons actually ability in the whole asset cycle. that's one thing. It's important to really actually use the new technologies that service providers are experts on it. Why don't you really actually use it instead of creating your own army? That's the important one. The other one, always service providers bringing different contribution into the property management. I think it is important also to look at holistically to the point. Of course, using in-house property management team is very give you a lot of flexibility and give you a lot of also kind of agile work style. Because at the end of the day, the service provider has own processes and own really actually systems. But in long run, it is always important to look at the major contribution factors, which I believe outsourced providers are really actually bringing a lot of different expertise, new technologies, know-hows, and the risk management factor is much actually well managed in that outsource provider services.
Another question from Bushra, perhaps Arron, you could answer this. Can property management assist in generating revenue, and how?
Yeah, I mean, obviously the most immediate answer to that is the rental income. But if we move away from that, because that's obviously given as property management services, there are certainly other areas where a property management company can assist with additional revenues, and it's just about looking at the space and taking some time to look at the avenues of additional revenue that you can source. You know, it's how is the car park managed? Can it be monetized more effectively? You know, is it being used effectively, and all the space is being used? If not, how can we look at creating additional revenues from there? Very simple storage solutions, for example. You know, if that's something that your tenants require and you can utilize space that wouldn't necessarily be allocated for that, then you can monetize those spaces as well. Increasingly, what we're looking at the moment is looking at spaces that can't be used as storage, but you know we can utilize, and offering that as space as a service. Can we build in a communal meeting room that can be booked on an ad hoc basis by the tenants that might not have that space in the smaller units? So there are all sorts of avenues for additional revenue that we can look at, additional to the standard rental income. In fact, last count, 2.2% of our 2% of the revenue we create is from additional revenues added on from rental income. So it's certainly always something we look for in a building. It's not always possible, but where possible, we will definitely maximize it.
David, a question from Ian. Do you see a trend of global companies being reliant on international property management companies, or is it more localized support on a country-by-country basis?
I think it varies hugely. I think the international companies bring, as I've mentioned before, sort of best practice and probably a comfort to a lot of tenants. But I think, you know, if I was in a sort of corporate position or maybe an HSBC position, I think I'd be looking at both solutions, because sometimes international companies aren't able to service some countries that easily. If I look at, say, Saudi Arabia, sometimes it's actually better to maybe use a blend of international and local companies, just because of things like licensing, ease of access, visas, those sort of things. Sometimes the barrier to entry is probably quite high. Sometimes also, you know, there are countries which are maybe politically sort of unstable, and therefore it's maybe easier to use a local provider. I know as JLL, we would have oversight typically on countries. So we may have more control in say Dubai and Abu Dhabi, but maybe in, say, if we had some in Beirut, for example, we may have less control, but we'd have local companies providing the services, but we would have we'd be on the hook in terms of the liability. So we're still there to make sure it works, but we would utilize, we would be flexible to use the right model for the right country and the right client.
Okay, thank you. So that brings to an end the panel discussion today. Thank you very much to everybody. And I think it goes without saying, if anyone has any further questions for any one of us, we're all here and more than happy to answer any questions that perhaps didn't get answered today as part of this session. So thank you.
Thank you very much, Lindsay.
Thank you.
Thank
Thank you, Lindsay.